Hello, everyone. Welcome to Cutting Through the Noise, our monthly investment webcast. I'm Samantha Geyer, the Marketing and Communications Manager at SignatureFD, and I'll be today's moderator. Before we dive into the presentation, let me tell you a little bit about Tony and our firm. Tony is a partner and Chief Investment Officer at SignatureFD. His curiosity and study of market history and portfolio construction have led to a career spanning more than 15 years. Tony chairs SignatureFD's investment committee, which is responsible for the firm's investment strategy. He represents SignatureFD at industry events and has authored articles for the Wall Street Journal, Barron's, Financial Times, and other industry publications. SignatureFD is a financial advising firm headquartered in Atlanta, Georgia. We believe in helping our clients achieve wealth beyond money. We empower our clients to use all elements of their wealth, their time, their resources, and their relationships to create a financial design that helps them grow, protect, give, and live their wealth to the fullest. This holistic approach to wealth management is a little something we like to call net worthwhile. If you're interested in learning more about how we can help you activate your wealth and start your journey toward your net worthwhile, please visit signaturefd.com/blueprint after the presentation and take our short online quiz to get started. We will be answering your questions at the end of today's webcast, but feel free to enter them as we go along into the Q&A panel. Simply hover over the Zoom window to see a toolbar appear at the bottom. Select the Q&A button to open the Submit a Question prompt and type in your question. We're happy you're joining us today and look forward to giving you some insight into the current economic and market data. With that, I'll turn it over to Tony to get us started.
Thanks so much for that overview, Samantha. Over the next 5 to 10 minutes here, we're going to be going over kind of some of the things that we've seen in the headlines and try to kind of shift through what is news versus what is noise. Throughout the course of this time, here are the main points that I hope you take away from today's webcast. So first, stocks have gotten off to a strong start this year and really have been pretty strong for the last 6 months or so now. Leadership has really resided with the growth stocks that were hit the hardest in the bear market last year. And we're going to spend a little bit of time talking about how the fundamentals have actually improved this year, providing some support for that strength in these trends that we've seen. Now, there are several commonly cited bearish narratives right now. Relatively narrow market leadership, that's been getting a lot of the press. And we're going to take a look at whether that should or shouldn't be a valid concern. And finally, the debt ceiling and de-dollarization, those are two political or geopolitical topics that have been very prominent. So we're going to talk about those a little bit and how those are feeding into this wall of worry that the market's been climbing for the last 6 months. So let's look at the rally thus far. Now, as of a few days ago, large cap US stocks were up almost 10% on the year, and that's kind of the purple line you can see here. The leadership has been in the growth style. That's really your tech stocks, consumer discretionary, communication stocks, those sectors. That's what you see, the blue line there. And then value stocks, which are dominated by safe havens like utilities and consumer staples, and more cyclical areas like energy, real estate, banks. Those stocks have lagged, but it hasn't been a disaster, and that's what you can see in the orange line here. So what exactly is driving that rally off the October low? So in this chart here, I want to showcase the relationship between market valuations and earnings. Now, the orange line, that's the price to earnings or PE ratio on the S&P 500. We're going to use that as our proxy for valuation. And the purple line, that's operating earnings. So those are the earnings that are associated with the core business lines of these companies and the expenses that go along with those. Now, note that valuations peaked way back at the end of Q4 2020. They went from about 40 times earnings to now 22 times earnings. So stocks cheapened quite a bit in that time frame. Now, what tends to happen is that valuations contract, and the contraction in valuations is discounting future earnings weakness. And that's exactly what we got from the end of 2021 to last year. But what's been interesting lately is picture. So this rally, it has actually had some support from profits, which that's been good to see. Now, here at SignatureFD, we read a lot of market research. Sometimes the narrative becomes very one-sided, and when that happens, it typically pays to lean against that narrative. Now, going into the year, I noticed that the narrative really was getting one-sided. It was that earnings were going to surprise to the downside, not the upside, and that earnings weakness would drag share prices even lower than they were last year. But that's not what's happened. So here, the blue line that we're showing, that's showing the percentage of companies with positive earnings surprises. Now notice that it's turned higher, and what I've circled here is that it's near 80%. And what that means is that 80% of companies have reported earnings that are higher than what was expected. Now that's actually a pretty decent number for this far along into an economic expansion. Now what I really want to drive home is that markets do not price based on whether the data is good or bad. Rather, markets price based on whether earnings are better or worse than what was anticipated. So what do we think about earnings going forward? Well, there's always going to be unknown events out there that can create an unforeseen surprise, either to the downside or the upside. But we think earnings can in fact be solid for the next 2 quarters. The first thing that we're going to look at here is inflationary pressures. Inflationary pressure has largely come off the boil for these companies. Now here in this chart, what we're showing is an inflation model from our friends at Ned Davis Research. That's the 3rd clip on the bottom in light blue. Now this takes 20 different inputs to tell us if the environment is ripe for accelerating inflation, or is it an environment that's supportive of decelerating inflation? Now the data is very clear in this, that inflation is likely to continue to downshift and decelerate from here, at least for the next few months, maybe even the next few quarters. Now, interestingly, when inflation pressure has been low, that's been one of the better times to be invested in stocks. The Dow has averaged a gain of about 13%, not even including dividends, per year when this has been the case, when inflation pressures have been low. And that's because weak inflation pressure, that helps to take stress off of profit margins for these companies. So if margins are potentially going to be pretty solid, what it's going to come down to for corporate earnings is going to be top-line revenue growth for these companies. And for that, what we would point out is that sales growth tracks nominal economic activity really well. And that's what this chart here is showing. Nominal economic growth, which is just the growth that you get before stripping out inflation, that's the blue line. The red line is corporate sales growth. And remember that sales and earnings are reported nominally, not after inflation. Now, a few things here. First, the Fed is tight, and that supercharged growth from the pandemic period, that has softened. Nominal GDP is moving lower, but it's sitting around 6 to 7%. So the economy is still growing very fast. And second, what this means is we can expect that there may be decent sales growth in upcoming quarters. Labor inflation has softened considerably, so I suspect that margins will stabilize and be pretty good, and earnings may be stronger than expectations going forward. Okay, so let's move on to some of these bricks in the wall of worry. First, market leadership, it has in fact been narrow. And what we mean by that is that relatively few stocks are driving the lion's share of the market's return. Now, this chart here from empirical research, is showing just how much of the market return over the past 6 months has been explained by the top 5 stocks in the index. Now, at nearly 60%, this is about as high as this number has ever gotten. But the question for investors is, does this really mean anything for the next 6 months? And the answer is no, not really. Empirical also shows this data. This is the next 6 months of returns after different levels of market concentration. Historically, what's happened the past 6 months really doesn't have any bearing on what happens over the following 6 months. And here's where we are today. Returns have been about average in the 6 months following those highly concentrated advances. So I wouldn't really read too much into the narrow leadership concern. It's one of those things that sounds like it should be ominous, but the numbers haven't really proved that out to be the case. Now, what about the debt ceiling? Now, I'm not going to tell you that the debt ceiling doesn't matter, because it does, and I'm about to show you some data on why it matters in the next slide. But in the immediate term, we can take a look at what the market's response today has looked like to what happened in the 2011 debt ceiling debate. Now, in each of these clips, the solid lines are 2011, and the dashed lines are what's been happening today. And we can see in the top clip that stocks have held up better this time around. Gold has rallied a bit, but much less than it did in 2011. And the dollar is tracking similarly to what it did in 2011. So there are some similarities from an economic perspective to that time period. But one glaring difference is that the market was coming off of very strong years in the post-2008 bull market rebound heading into 2011. So potentially the market was overbought and ripe for a correction. Now, when we take a look at this year, the market's coming off a very weak 2022 period and was coming into the year more oversold and not as much in a position of strength from the prior rally. So that was a major difference to what we're seeing. Now, here's where I want to talk about why the debt ceiling debate does matter. Now, our research providers, they continue to believe that a deal will get done and that a true default date is actually much further down the line than that June 1st X date proposed by Treasury Secretary Janet Yellen. What may be more important for investors rather than just a resolution to the debt ceiling, in the long run, it's going to be, what does a deal look like? In 2011, the Budget Control Act created a massive drag on economic growth. Remember that government spending is a direct component of GDP or economic growth. After the 2011 Act was passed, there were 15 straight quarters of negative contribution from the government sector on economic growth. That's a record span of negative government contribution. Now, if the deal that we get this time around introduces high levels of austerity, that could result in another significant drag on economic output. So we're going to be watching for not just do we get a resolution on the debt ceiling, but what does that resolution look like? Now, regarding the dollar and this de-dollarization story, we've seen quite a few concerns voiced over de-dollarization. Now, the first thing that we want to point out is that de-dollarization is not just a switch that gets flipped overnight. The dollar remains the dominant currency in the global economy, and it's not even close. Here in this chart, we're showing different currencies and the percentage that they are utilized in all foreign exchange transactions. Note that the dollar represents one side of the trade on 88% of all Forex transactions. Yes, the yuan has picked up some market share, but it's also it's done that largely at the expense of the euro, not the dollar. Also, the dollar remains 60% of all foreign currency reserves in circulation. I would also point out that for another currency to displace the dollar, there likely needs to be several conditions met. Economic heft is one of those, but a free and open economy is also of utmost importance. And that currency needs to be backed by a country that's willing to run current account deficits, not surpluses. In other words, they need to import goods from other markets and export their currency and their bonds into the other markets. And it doesn't look like there's many other currencies that look right to do that at the time. So what we want to end with here in the presentation today, just a reminder that there's never going to be a time that bad news will not dominate the headlines. The job of the media is to keep our eyes glued to the screen and remember that fear sells much better than most other things. But long-term investors that can stay the course through this noise, though they've been tended to be rewarded through time. Now, in this chart, I want to illustrate just how bad the sentiment's been in this market rally. Now, the top clip here is the S&P 500, and it shows that the rally from below 3,800 to nearly 4,200 since October. Now, the bottom clip is an investor poll that goes and asks investors, where's the market headed over the next 6 months? Now, in the latest reading, about 23% of people said higher and 40% said lower. The rest were neutral. Now, readings here below 50 on this chart, that's the dashed blue line, that means that there were more bears in this survey than there were bulls on net. There has been a persistent pessimistic feel throughout this entire rally, and that continues today. Now, the crowd is not always wrong, but on average, the crowd tends to be wrong. We generally want to lean against the prevailing sentiment in the crowd. Now, to recap, the stock rally thus far has perhaps been more supported by fundamental improvement than market participants and pundits expected heading into 2023. Now, 3 bricks in the proverbial wall of worry have been narrow market leadership, the debt ceiling, and de-dollarization. And all of these things could potentially matter, but hopefully we touched on our thoughts around these topics well enough today. And one of the things that all 3 of these things have done is to keep sentiment very negative despite this near 20% return from the October low. Now, rallies historically have tended to run out of steam once sentiment becomes overly optimistic, not when sentiment has been this pessimistic. So optimism is certainly not the case today. So let me share with everybody our disclosures and see if there's any questions this month. Okay, it looks like there's no questions. If you think of anything that you'd like to ask us, feel free to email us at SignatureFD@sigfd.com, and we will be sure to get back to you. Thank you for joining.